Hello, everyone. Welcome back to Scaling Up 2021. We had a great series of panels yesterday, and I'm very much looking forward to today's panels. This is our Finance and De-risking Day, because if we're going to capture the bioeconomy market, we can't do it without assembling the necessary pieces of a successful project finance. I want to start by again thanking our overall conference platinum sponsor, EcoStrat, who's been supporting Scaling Up since 2017. And just before we get started, a couple of housekeeping items. If you have any questions for our panelists, please type them into the Q&A box. Don't use the chat box. If you want to let someone know you are attending, use the chat box for that, just to say, hi, Jeff Passmore from Ottawa, and have a conversation and exchange email addresses. We have 427 registrations, so there's lots of people you might like to know who else is on, and you can use the chat box for that. In Canada, we've got people from Whitehorse to Calgary, Saskatoon, Winnipeg, and Halifax, and in the US, from Portland and Los Angeles to Houston, New York, and Washington, DC, as well as registrations from the UK, Italy, Sweden, Poland, Macedonia, India, Egypt, Uruguay, and New Zealand. And of course, from the Canadian federal government, we've got registrations from Natural Resources Canada, Environment Canada, Ag Canada, Global Affairs, and many other departments. In fact, one of our speakers today is from Export Development Canada. I know you're all interested to know who else is attending, just as if we were all at a live event, so use the chat box to say hello. But when it comes to asking questions of our speakers, click the Q&A button and type your question into the text box. Then our session chair, in this case, Matt, will coordinate the questions and ask them on your behalf following the presentations by all the panelists. The webinar is being recorded, so it'll be available to all registrants on YouTube following the end of the conference. Could I also ask panelists who are not speaking to please mute your microphones until it is your time to present. The sponsor for the first panel this morning is New Energy Risk from California, and our session chair will be Matt Lucas, Managing Director of New Energy Risk. Thank all of you from the West Coast who are up bright and early for this panel. I know it's 8 a.m. in California and British Columbia, but Matt and his team are going to lay out the basics of bringing a project together to make it bankable. So we are all looking forward to the discussion, and I want to thank you, Matt, for putting this panel together. Over to you, Matt.
Good morning, all, and thank you so much, Jeff, for the kind introduction. My name is Matt Lucas. I run business development at New Energy Risk, and I'm thrilled to be leading this panel today with my esteemed fellow panelists. Our goal today is to lay out the puzzle pieces for successful project financing. Next slide. When we think about a project financing, we think about this like a jigsaw puzzle, where each piece is a risk. And for you to assemble the pieces, you need to find a party and a partner who's able to lay off those particular risks. As you lay off those risks, you can assemble the puzzle pieces into a successful project financing. That's your completed puzzle. The reason I think this panel is really interesting is that we've got this really all-star lineup of folks who are here to help you. So we've got a representative from one of the largest EPC firms that has experience in the bioeconomy. We have representatives from both public and private debt solutions, as well as 2 representatives from private equity. And so across all of those expertise, we think we've got the right people on the panel who can address each of these risks, whether they're technical, commercial, financial. Now, I certainly hope that my firm, New Energy Risk, can be one of your partners in assembling your own project financing puzzle. New Energy Risk is an insurance company, and our role here is to make your project possible by laying off certain risks. We're best known and have been around for over a decade and facilitated over $3 billion worth of projects by laying off technology performance risks, both during commissioning and post-COD during the ongoing operations of the project. But we're much more than that. We also handle certain other risks, commercial and financial risks, whether that's related to, say, the value of your floating environmental credits, that's an offtake risk, and in some cases related to feedstock as well. So I'm looking forward to working with my fellow panelists on this during this event to lay off some of these risks and see how we can enable some projects. So what we're going to do is each panelist is going to take a couple of minutes, introduce themselves, their organization, what they've done recently in the bioeconomy, and how they can contribute to filling out your own puzzle. We'll start with Jim.
Thank you, Matt. Hello, I am Jim Pepper with Wood. I am based in the Atlanta, Georgia office, but our division has offices, our renewable energy and power division has offices in Vancouver, Ontario, and Toronto, and multiple smaller locations. Our division has experience delivering consulting on these feasibility studies, the FEL1s, the FEL2s, and we've taken them to negotiated EPCs. So as a group, our engineering team has taken these projects from a concept. We have helped our clients on a journey similar to you to get your scope defined and get your credit worthiness pulled together, so you have something you take to the bankers and say, this is our project, this is what it's going to cost, here are our risks. Some of the best practices we've done with clients is we get involved early on, we review the process, we look at resource management, we look at the technologies, we can do studies on the risks of the technology, what is truly first of a kind versus what is technology that you can rely on. We can balance that technology with various approaches of doing estimates, factored estimates on cost of items that maybe aren't fully defined, to giving you full quantity-based takeoffs, so you can take your project and begin to segregate what parts of the project are at a higher risk versus what is a known quantity and man hours to deliver. We can help as a project goes from a feasibility study to actual construction. We can take those risks and slowly define them with you. We do have experience with performance guarantees. I think one of the things that the EPC company will not do would be wrap performance of first of kind technology. But for sure, balance of plant, an EPC could wrap some performance. So at least you know your utilities have a performance guarantee and you've taken that risk and you pushed it over to the EPC with regards to process. And then the risk you may be carrying, or maybe a third party may carry, would be the actual developed the technology that you're currently developing. Recent projects we have done, we've done projects in Canada. The first biofuel type project I was ever involved with was in 2009, part of the Green Transformation Program in Canada, where we helped a paper mill put in a steam turbine to help and take advantage of the credits that were done in 2009. More recently, we've taken a study for a third generation ethanol plant. We took it from a concept to a $135 million EPC and helped the client commission that plant. So the experience we bring is we'll take you from a study, we'll get you an EPC estimate or an EPC contract that you can then take to the banks and get it developed. And Matt, I'll hand this off to the next guy.
Thanks so much, Jim. So that's really helpful, understanding that you're a really key partner in terms of both defining cost scope and engineering scope, moving toward that really bankable EPC contract. And I'm sure some of our lenders and equity investors are going to speak to the importance of that EPC contract. So next up, JP.
Thanks, Matt and Jeff for inviting me. I can say it's a real pleasure to be part of this panel, very diverse and knowledgeable panel. Maybe just to start off, an intro on myself, EDC. So I'm Jean-Philippe Nollet, Director and Head of EDC's Project Finance team covering renewables and sustainable technologies. EDC is Canada's export credit agency. We have a mandate to support either domestic projects that are exporting or have an export potential. And we also support international contracts and investments from Canadian companies. We do this through a broad suite of products, everything from financing to insurance to provision of knowledge. And we're a financially sustainable Crown corporation. So meaning our loans are structured on commercial principle, and we're also a balance sheet lender. So maybe to take a bit of context as to, clean tech at EDC. So clean tech is a key priority of EDC, as it is to our sole shareholder, the Government of Canada. In 2020, we supported 288 clean tech companies, and EDC solutions facilitated $4.5 billion of clean tech business. The team that I managed specifically focused on project finance debt, where we structured and managed a portfolio of nearly $3 billion in loans and underwrote $1 billion across both domestic and international markets, and a wide-ranging suite of asset classes. Clean tech's been a priority at EDC since dating back to 2012, and our goal now and into the long term is really to continue to play a leadership role in the industry. And in doing so, among other things, we do have an expanded technology risk appetite in the space. Another question we get often is, how is EDC integrated across the clean tech financing ecosystem? It's important to know when you're looking at the capital stack, EDC is never going to be the sole funder for project financing. We always want to see a certain level of private sector capital backing these projects. That being said, we want to also help mobilize that capital, and we do get engaged fairly early on. I said we can't be the sole funder, but we can be the sole debt financier for a project, recognizing that we do have this expanded risk appetite. But again, in the spirit of mobilizing capital, we do look for partnership opportunities, whether that be working bilaterally with another bank, or bringing someone like a new energy risk on board to help cover and some of these risks that perhaps commercial banks aren't comfortable with. And the idea there is really that we're there to support the project, but the more the client sort of develops those relationships with the private sector, the easier it will have to finance the second, the third, the fourth, the fifth project that is trying to scale up. The other piece is, how do we integrate across the broader suite of agencies and departments in the Government of Canada? And we take what we call a whole of government, or a Team Canada approach. And this is really important to EDC. So what do I mean by that? We work very closely with our financing partners, and it's a fairly broad list, but to mention a few that we work very closely with: Sustainable Development Technology Canada, or SDTC, Business Development Bank of Canada, BDC, are all players that we work routinely with. And there's other players in the ecosystem. So Trade Commissioner Services, TCS, Canadian Commercial Corporation, Natural Resources Canada, Innovation Science Economic Development, and Clean Growth Hub. These are all players that we routinely engage with to try to support these companies. And what are these partnerships meant to do? Is to ensure that companies are not falling through the cracks, but instead receive the appropriate solution from the appropriate arm of the government at the appropriate time. So maybe setting a bit of context for the panel in terms of what I can bring to this discussion, but also just in terms of establishing the landscape. Canada has a really large pool of both established and emerging expertise in the clean tech subsectors. And part of my role is not only supporting sort of well-established technologies like wind and solar, but how do we scale up some of these clean technologies that are early commercialization projects? And I'm really excited to be part of this panel for that reason, because it represents, as Matt said, views from each one of the key stakeholders across that stream that make these projects a reality. And quite honestly, it's an exciting time to be a clean tech company. You've got the backdrop of COP26. You've got, daily announcements, if not hourly announcements, on policies, funding programs, all designed to support innovation and low carbon technologies. So hopefully, sure it'll be a very exciting conversation. And with that, Matt, I'll pass it to the next speaker.
What's a typical loan size for you?
Good question. I think we're fairly broad. So given that it's project financing, I think the typical loan size would be north of certainly north of 10 million. But EDC can support quite large tickets. So we routinely do loans in excess of 150 million for sort of established technologies. So it really depends on the project and the scale that we're talking about.
Great, thanks. So switching over to our next panelist, we have David, which represents a private lending solution. So I'll be interested to see the contrast between the public and the private.
That's perfect. Thanks, Matt and JP. That's a really nice segue into myself and introducing Vancity. Many from Canada will know Vancity is the largest credit union in Canada, 500,000 members in BC and a $30 billion balance sheet. Part of the Vancity group is the Vancity Community Investment Bank, and that's where I work as the head of deal structuring. Vancity is well known for being a first in many aspects and very progressive social and environmentally. Was one of the founding partners of the Net Zero Alliance on Banking. And part of our mission and our mission statement on our website is to finance a sustainable tomorrow. And so that translates through into the work we do at the Vancity Community Investment Bank, where we finance sustainable real estate, sustainable and impactful businesses through our commercial business banking suite of products, and then sustainable and clean energy projects, which is where we do project financing work. Because part of our mission is to finance a sustainable tomorrow, that leads us to be what I would think as one of the more creative and progressive lenders in the market, which means we've done some of the first geothermal lending across the country, some of the first battery storage project finance across the country, some of the first waste to energy projects, specifically taking waste heat from sewers to power a hospital in downtown Toronto. And we've worked with others on the panel like Duncan and the team at Forum on some really innovative geothermal platforms, alongside doing more traditional solar and wind. So I think we dovetail really nicely where the groups like EDC and others from the public sector are trying to crowd private debt and private capital in. We put up our hands and say, yes, we want to be some of those first groups to be crowded in and participate in those projects. When it comes to the bioeconomy, we've seen a lot of different projects and proposals and proponents across the country over the last particular 12 months. I think as JP alluded to, especially at the backdrop of COP, there's a lot of interesting activity and a lot of projects that have either been in the pipeline for a while or starting to come to fruition. And so I think the 2 points I wanted to make here at the outset are, one, how important it is to understand that puzzle piece, Matt, that you put up as your first slide, or to understand the world of project finance and the language of project finance, so that when you're coming to groups, whether it's JP at EDC or the rest of the government of Canada or ourselves, you understand how we view the world, which is different than how a commercial banker or a commercial lender looks at the world. We're really looking at these as long-term assets, and we want to understand those puzzle pieces. What's the technology? What are the risks and where are those sitting? What are the feedstock? What are you getting? What quality, quantity, under what types of contracts? What are you selling? Again, to who, what types of contracts, and what are the risks? So for a lot of project developers, that might be inherent in your DNA and how you know how to speak those languages. If you don't, this is a great panel to come to learn more, but find that talent, hire that talent, partner with that talent, find advisors to help, and be able to speak that right language to put those puzzle pieces together. I think the second point that I'll make here at the outset is just how much support there is and how many groups there are cheering clean tech companies and companies in the bioeconomy alongside. Whether that is all of those different groups that JP mentioned, alongside the Canada Infrastructure Bank, now putting out lots of money into the clean energy economy. The announcements coming out of the US and the Department of Energy there, you're doing US-based projects. Bill Gates and their group through the Breakthrough Catalyst Fund announced 4 key sectors. One includes sustainable biofuels and $1 billion that they want to use to specifically de-risk projects and take commercialization risk. Private sector solutions like MAT and New Risk new energy risk that try to buy that risk and make it easier for projects to get financed. There's so many people on the sidelines cheering to get projects financed and projects built that it behooves project developers to make sure you know that landscape. So there's a separate puzzle piece of who are all the different players, how can they be helpful to me, and how can I best get all of those different programs together to build a successful project alongside my EPC provider and my insurance provider and my lawyers, who are a really important part of that. So I'll leave it there for now. I'll answer your other question, Matt, that you asked JP, which was at Vancity. Our size is, and our ticket size, we've done about 100 million of projects this year, ranging from, on the smaller side, 3 to 5 million, where we'll go that small if we think there's an interesting pipeline to build out with a group, up to 30, 50 million that we'll do ourselves. And then we love syndicating with other groups. We closed a deal with the Canada Infrastructure Bank a few weeks ago, and we love to do more business with the public sector that's helping to de-risk projects. So I'll leave it at that. Thanks, Jeff, for organizing this important conference, and Matt for sharing us.
Thanks, David. And now we're going to move from debt to equity, and we'll move to Kareem.
Thanks, Matt. It's a real pleasure to join the panelists here. I'm based in San Francisco, Vice President at Azimuth Capital Management, which is based in Calgary and has an office here in California. So in my role there, I look after origination and the low carbon fuel vertical for the firm. That really means looking after molecules and not electrons. So if you think about hydrogen, biofuels, carbon capture storage, ammonia, renewable diesel, that kind of stuff. So I spend most of my days talking to developers and entrepreneurs on the ground, trying to get projects built in North America. My background for reference is in engineering. I spent the past decade kind of building and running plants. And so I get a good sense of kind of mixture of technical and finance when I talk to the folks, and that's something I really do enjoy, giving people kind of the chance to be able to talk about their tech and feel that they're being understood, and that's something that we pride ourselves here in Azimuth. Almost half the team is kind of has a background in engineering or operations. Azimuth itself is a 20-year private equity firm with around $3.5 billion under management. It's a firm that's had its starts in Canadian kind of upstream oil and gas, with subsequently starting around 15 years ago, increased exposure towards energy transition, and that's been increasing over time. At the moment, we've started fundraising for a fifth fund with a sole focus on energy transition. And that includes kind of three spaces. So one of which is the low carbon fuels that I was talking about. The second is energy electricity resources. So think of graphite, lithium, other things like that. And then the final one is baseload power. The strategy for Azimuth is investing in real assets, but with a tech component. So taking on some tech and dev risk, but really it is about getting it deployed into an asset. In order to achieve private equity returns and 20% plus, you need to take on risk, and so we find ourselves often looking at serial one type builds, and so that's pretty much the space we talk about, and so this panel is very interesting to see how others think about it too. Like I said, plenty of engineers on the team, plenty of technical advisors, but one of the things that you'll see me talk about a little bit is that we're really, really slow. So when we start talking, it probably takes us 6 months to feel confident, comfortable, and having really dug into the technology, and so see the long-term value. On the Canadian bioeconomy specifically, so I spent the past year working with a Canadian waste conversion technology company, and we ultimately got to a deal with them and spun out a project developer that is using their technology, sort of where they remain as a tech co. We have a dev co that we're running after, and so Azimuth launched that and seeded it, and so we're running it like that. I probably spent probably a third of the entrepreneurs I talk to come out of Canada and developers. So it's very, there's a lot of really interesting action happening on the ground here. Just to answer Matt's question in terms of transaction size, we typically like to deploy, north of 50 million into a company, whether that's into the project or the topco, which could be the development company shop that's going to be building a platform, for instance. Ideally, serial one is commercially is cash flowing more than break even. And if we're looking at a specific project investment, we target, say, 20% IRR minimum. If we're looking at a platform type of approach, then you could lower that IRR on the first project and look at the bigger picture, and try to assess it that way. On the higher end, we typically don't like to get too overexposed, so I'd sort of limit it to 125 million per company. So what that really means is, you can go for a serial one type build, but it's not going to be it's not going to be a project that, and I've seen plenty of this show up, is serial one tech applied in a project worth $1.5 billion, and you're just, I'm sorry, not the right shop for you, but I've seen plenty of those, and we'll talk about that a little bit later. Yeah, and that's me.
Yeah, I'm not sure that making your serial one over $1 billion is ever a best practice, but we'll maybe address it. So next up, Duncan.
Great. Good morning, everyone. I'm excited to be on this panel. I'm Duncan Ramen. I'm at Forum Equity Partners. Forum is been around for about 25 years. We are a real estate infrastructure and private equity investor and developer. We have about 1.6 billion of assets under management. 27 people or so here in Toronto, growing very quickly. I think we have 12 open positions or so. I run our private equity business, which is really private equity and infrastructure. We focus on a lot of the same things that Kareem's focusing on, although perhaps a few other pockets. Largely the energy transition, and less so things like utility scale wind and solar, which has become de-risked and a little crowded, frankly. More on emerging technologies, serial one stuff, as you say. We have a geothermal platform that David mentioned. He's Vancity is a lender to, providing heating and cooling services to condominiums in Ontario. We're looking at things like RNG and a waste to value plant that we're currently developing, hopefully in partnership with Matt and the team at New Energy Risk in New York State. Which will take a couple 100,000 tons of municipal solid waste and translate it, I guess, compost it into organic matter, which will pelletize and send into the biomass market. Roughly comparable characteristics to wood pellets, and so it's a really great ESG story. We're diverting many tons of municipal solid waste from landfill and then effectively displacing coal from incineration on the other end. We're also looking sort of tentatively at some of the newer technologies around carbon capture and hydrogen. We're not quite as, I don't think, as smart from a background perspective as Kareem's group. I wish I had a couple engineers, any engineers in the team. We look to friendly partners to help us uncover those things and mitigate those risks, like the folks like Matt and our EPC partners and independent engineering support. You'll probably, actually, I should have mentioned this. You may, if you've ever come to Toronto, you may recognize some of our assets. We built the Billy Bishop Airport Tunnel, which takes folks from the island airport to the mainland instead of through on the ferry, and did a whole bunch of P3 assets as well. We sort of exited that and focusing more on core real estate and the energy transition. I also focus on building services. We have an HVAC platform and energy efficiency initiatives, mostly for the built environment, obviously, and telecoms. We can do minority investments. You know, a lot of that's growth equity, where we like to partner with existing entrepreneurs to accelerate their platforms. We can also do buyout, and then in the project space, we'll you know, primarily be the sole or maybe partnered with another project equity provider. Yeah, it's great to see that at the panel. We've worked with Dave and his team a couple times, the geothermal platform, as well as a residential rooftop solar platform here in Ontario, and looking forward to more of that, and likewise with Matt. And I think there's something coming down the pipe, JP, that we may be interfacing with on soon. So yeah, excited to dig into the panel here.
Great. All right. Well, thank you, everybody. So thank you, Rick and Gunnar, for your questions. Keep them coming in the Q&A. I'm going to just kick off this round by having all of our panelists, and we're going to start with Jim and then go to Duncan in the same order, talk about speaking to our audience of technology developers and project developers. What are some best practices and maybe some practices to avoid when they're approaching you, right? We're trying to tee up this interaction to be as efficient as possible in completing your puzzle. Any recommendations you'd have for the audience? Jim, we'll start with you.
Well, you know, we are a EPC provider, so we're looking for a scope that we can look at and get our arms around and to deliver you a price. So we're looking for your technology to have a good explanation of how the technology works. What is the goal of the technology, and what have you tested in a pilot plant? Do you have plans for demonstration plan? Where are you in the life cycle of that technology? And so we can understand, you know, how do we take that, scale that up to an industrial size, and, you know, what do we need to provide with regards to utilities? So anything scope around knowing scope is very useful. The next thing we're looking for is a plan on what's your vision on financing this project? So, you know, I know I'm the first one speaking in this group, but a lot of times you're not going to get an EPC contractor on board until you finalize your financing and your plan and your cash flow. Obviously, we can help you, because we can do the studies and we can do the cash flow analysis, and we can help decide, you know, what is the total installed cost of this project. You know, before we get too engaged and too much of our money invested, we want to understand where your funding is coming from, and you know, what is the timeline, what is the speed to market, and pass it on.
Great. Jim, maybe sort of following up, so you touched on a lot of good points that we look at, maybe picking up on a few other things. And you know, David from Vancity alluded to it before, is that, you know, as a financier or project finance debt provider, it is a specialized product, and you may have people that are, you know, very good at understanding their technology, have maybe gone through a couple of equity raises at their holdco level or corporate level, but to understand kind of the inner workings of putting together a specialized financing product like project finance, you do need that sort of bench strength. And there's really two ways of getting it: is either you get it on your management team, or you can, you know, effectively farm it out and get a suitably qualified financial advisor that has sort of, you know, credible past experience in executing project financing. And that will really speed up the process of execution and will also increase the chances of success. And the reason being is that there are, you know, to come back to Matt's puzzle, there's a series of pieces that all need to come together. And, you know, we do have, as I mentioned before, we have an expanded risk appetite, but it does, you know, our support does require that basic fundamentals of project finance are sort of adhered to, and that proper risk allocation is done. So that's sort of maybe the backdrop. We can get into a lot of those points as well, but maybe, you know, one other point in terms of when to engage with lenders is I think the business case needs to be sort of clearly articulated through, again, because we're talking about project financing. Project finance is a cash flow lending business and is supported by sort of very clearly defined contracts. And to Jim's point, it's a bit of a chicken and egg where you need to advance things to a certain level in order for institutions, financiers to kind of give you credence or give you the support that you need and believe that there's a pathway to success. But at least having sort of heads of terms of the key contracts and understanding how these things fit together, I think is key to really advance as a first step when you're putting together these projects. So I have a long list, but I'll leave it at that and maybe sort of pass it on to my colleagues. I think David, over to you.
Thanks, JP. I think we see the world in similar light, where the best types of conversations, and look, I think it's very exciting to be a developer. A lot of my colleagues have sat in the developer seat building a project. I also empathize with some of the pain of having to try to push everything along at once, where the EPC says, well, finish all your financing and then come talk to us. And we say, well, finish all your EPC and then come to us. So there is sort of a step type of approach. For us, we're happy to be helpful and have a couple early meetings, give you an idea on how we think about the project, maybe even give you a discussion paper that you can take around to say, look, at a very high level, we've spent an hour talking to you and looking at some information. We spent an hour digging into some materials. Here's 50,000 foot view on how we would see it. And you can use that to advance some conversations. I think to get that, the best way of coming in is presenting that information in a way that's easy and for us to digest. Those puzzle pieces are so important. And the buckets of risk, or the buckets of what's the technology, where has it been used before, or has it been used before, what's new about it, what's not new, and how do you think we as lenders can get comfortable with that technology risk? Are you hoping that we understand it and that we use independent engineers and engineering groups to help us think about it, but just get comfortable with it straight out? Are you going to groups like New Energy to wrap that risk? Are you going to your EPC, who might be a partner and willing to help wrap that risk? But being very clear about what risks there are and where they sit. Same thing on the feedstock side. A lot of bio projects have feedstock, whatever resources coming in. What are the contractual arrangements, as JP said, the sort of bullet points, heads of terms? Are you trying to buy municipal solid waste from someone for, from a municipality for 10 years under a fixed price contract? Or are you buying it on a spot market from someone off the back of a truck at whatever they're going to sell it to you at? Those are very different types of projects. And we can think about structuring from a lender side around those risks sometimes, but I think we'd like to know where you see the world and what some of those high level terms are. Same on the offtake side. Are you selling something at a fixed price, or how much market risk? And then a very simple version of a cash flow model, like JP was just alluding to. We look at things on a cash flow basis. What's your CapEx? How much money do you need, sources and uses? And what are your pro forma over the asset life, whether that's 5 years, 10 years? We'll look at assets that go out to 30, 40 years. We might not have a loan term that goes out that long, but a lot of geothermal and these big capital projects have that type of lifespan. And so every year, what's your revenue? Where's that coming from? How does it link into those other puzzle pieces? What are the expenses? What's the net income? And then what does that leave to service the debt? And so what are some of those ratios that we look at? So that's the perfect pitch to come in with, is like 5 slides: technology, offtake, feedstock, tell me your other risks, and we can have a really hopefully productive conversation to help you move forward, make sure you're talking to some of the other right groups, and keep you moving along in your development journey.
That's thanks, David. That's really great. I think you hit on a lot of points that I was going to touch, and I'm sure Duncan similarly as well. I'll add a couple of things. So David said that it's really important that it shows up easy to digest. I think I'll add one more thing on that, that it passes a stress test. So if it's all based on exaggerated carbon pricing and all sorts of, that's a huge red flag. It's really hard to recover from that in a conversation. And so I would just put that front and center. So easy, credible. These are the two things. A couple things that I'll add that are maybe Duncan and myself sort of relate to here is, for us, we like to consider ourselves as a partner and not just a capital provider. So I actually want to get to know the management team really well. I want to understand the bigger picture. How did the idea even come up? How are you thinking about it as a single project? Are you thinking about it as a series of projects? And if so, can you tell me about the market? Show me how you see the world. And David really mentioned, I want to know the main risks. Well, I want to know them because I want to help you with them. I might actually make introductions. I might be able to think through these risks with you. And so I prefer just being honest and open, and we'll see if the partnership can work and we can get to something. And there's obviously a balance there, right? Because if you overshare risks, then that's a leverage and negotiation potential. So there is a balance there, but I think if it's approached well, it's a win-win for everyone. The two things that I want to kind of touch on that we really care about in Azimuth are, number one is I want to understand the CO2 story really deeply. That really matters to me. Our funds carry is tied to our CO2 footprint. I need to know that on a dollar basis, are you going to mitigate more than a solar farm? Because if not, then I'm wasting my time and I can just put that money in a solar farm. So that's just the starting point. And so I want to understand that math. Is that math also written up somewhere in like California GREET models or the EPA warm models or other things? That it can't just be we're displacing coal and that's the end of the story. Well, are you chopping down forests for that? So ideally, let's follow a standard approach for that CO2 story. That would be really good. And then the second one, and this is related to something I brought up before, is again, if you're looking at a platform play, and ideally, if you're going for a serial one build, I do recommend that you go for a platform type of approach, because serial one, if you start to stress test the project model, it won't pass a lot of hurdle rates. And so the way you get around that, and I really do hope that folks maybe ask me a follow-up on this, is that you start thinking through how do you build a series of projects and then you exit as a platform where the next projects are better and better. So then you take a risk. You might lose some money in the first one. There's a backstop. The sponsor is willing to put some money in case it's extended, in case startups are a little longer, but the reward is on the back end, and the reward is on a different kind of story than a single project. That's my view. Probably we can slice and dice risk for a serial one and say that EPC owns that and this one owns that and everything. But ultimately, there are some risks you can't avoid. And so what you can do is make the reward larger. And I think that's the approach that I like to see and think through with entrepreneurs and developers. Over to you, Duncan.
Thanks, guys. You stole all the good stuff. Look, I mean, I think really David and Karim, you hit a lot of the big things. Especially that last one. Maybe I'll touch on a couple of them and hopefully add some new thoughts. The last thought, Karim, about a platform play. I think it's almost just not. There's no bid if you're asking us to do a single first of its kind project, do all that really hard work, get the thing going, and it's a one and done. There needs to be a long-term partnership. There's a ton more work on the first one and a ton more risks to deal with in the first one. And so we should all be focused on growing a platform that has, just a more attractive exit. I think the preparation point I want to dig into a little bit more. I mean, coming with a really clean story that's digestible, But project development, especially first of their kind projects, they're hard. They're messy. There's always something that's going to be a curveball. You're not going to have all the answers up front for sure. So to me, like sort of that screen of management team, developer team, are they going to be able to manage those hiccups over time? Good indications of that are, how organized are they? How much do they have their stuff together? Have they thought through, I don't want a super rosy picture of how the world's going to turn out, which is either glossing over things that, shouldn't be glossing over, we should be transparent about, or you're just not thinking through enough about the curveballs that thing, will eventually come up. Developers need to be, resilient, creative. They need to sort of figure out ways to get stuff done that, you're not going to know up front. So it's almost a character thing, almost a quality of approach. And that's not necessarily one person. That's often a team, whether they're on the team proper or they're partners. Another thing to sort of uncover that a little bit is past success. So maybe not with this platform, with this technology, but what have you done in the past? How did that work out? It doesn't have to be pure success, because there's a lot of learning there. It's like the venture capital model, I guess, in some respects there. But, is this team set up to figure it out? Back to the when to come to us question. Happy to, like David and I think Kareem as well, like happy to have those conversations relatively early. Also, we're not here just to provide capital. It's there's strategic support, there's thinking through stuff, there's adding bodies to help move things along. There's door opening, hopefully maybe sometimes some credibility with certain folks to move things forward. Introductions with other EPC groups, as an example. We don't want to spend too much time too early and spend a lot of dollars early, but we appreciate that we're not going to be able to do what we do and generate private equity returns if we wait until with a perfect bow on it at NTP. Here it is. That's there's a lot of folks that will do that, and it's less interesting, frankly. I guess it's the two sides of the coin. What should you be doing? How should you be approaching folks like us, and how should you not? It's really easy to lose integrity, or to break trust, I guess is the way to say it. So glossing over issues, we're going to uncover them. So please be upfront about them early. Please don't have extraordinarily compressed timelines that you're just bound to miss. Let's just be transparent and partnered on this, and kind of figure it out together. But as soon as you lose credibility, it's a pretty slippery slope.
Great. All right. Well, excellent thoughts all the way around. We heard about tech life cycle, clear and reasonable timelines, needing heads of terms, and the team and past success and track record are critical. I want to turn to the Q&A now. So for our lenders, there's some questions here around loan to value and quanta. So why don't we start with JP and then we'll go to David.
Yeah, so thanks for those questions. And, I would say that in terms of loan quantum, there's no specific minimum. I think it's more just in terms of economics of, how much time do you need to spend with a project finance lender versus, other forms of capital. The due diligence processes are different. So at some point it's more of a, a return discussion, but by all means, do approach us. I touched a lot on the Team Canada or the whole of government approach and some of the financial partners that we have. So we may be the solution, we may not be, but we'll certainly look for the right door on that front. On the percentage of a first of a kind plant, more speaking to gearing, I would imagine that question. That's a very good question and fairly nuanced in the sense that the technology risk is one thing, and then the sort of operating phase. So as a project financier, you really break it down to two phases: construction phase risks and operations phase risks. And each one has its own sort of issues that you need to contend with. And you want to have a proper sources and uses plan and a proper gearing during the construction to make sure people have skin in the game and are also set up for success. You don't want a company scrambling for additional funds when it's struggling through commissioning or completing the last parts of the build. And as a number of panelists mentioned, those things happen. It's difficult to get some of these first of a kind projects done. So you need to have adequate contingencies, and you need another sort of pool of funds, which is if and when, and it's more when, there are cost overruns, how do those get funded? And that's a big piece in terms of, you know, the overall gearing story. The other thing that plays into gearing is, I would say, cash flow analysis in terms of, are you dealing with a fully contracted, you know, fixed price, fixed volume offtake, and similarly on the feedstock side, whereas maybe your coverage ratios are a bit lower, your gearing's a bit higher, or are you in a situation where you're taking all sorts of market risk, regulatory risks, et cetera, and then the gearing goes down. So it is fairly nuanced. I can't say that there's a sort of strict minimum, but I would say that we do want to also see a private sector participation in the capital stack. And again, there's no strict minimum, but I would say, you know, in the 15 to 20% north of that in terms of private sector capital backing a project is probably a good rule of thumb to at least start from. And then it can go, you know, north of that depending on the risk profile.
I'm going to chime in on this one. Actually, we get asked this loan to value question all the time by our sponsors. It's one of our red flags when people come in with unrealistically high expectations. You know, unless you've got a fixed price 20-year sort of power purchase agreement, utility-esque, you're not going to be at 80 or 90% loan to value. Actually, the very specific quantitative feedback I'd say is that we see first of a kind serial number 1, 2, and 3 clearing. Don't think of it as a loan to value, but as a debt service coverage ratio. So it's free cash over principal and interest. And those are typically somewhere in the 1.6 to 1.8 range. So if you're coming from, say, utilities background, we're used to like 1.2 or 1.3, that sounds really high. But that's to account for the technology risk and also for the fact that a lot of these bioeconomy projects don't have fixed price offtakes. So the lender is also looking for slightly higher coverage ratios to account for that variability in the optics, so maybe not LTV coverage ratio.
Totally agree. Yeah.
I think that covered all of it. The only comment I'll say here is if any of these terms like coverage ratio, gearing are new or foreign, that's a great signal that you should be going out and finding one of the really talented financial advisory firms across Canada that can help you and is there specifically to help you navigate these things. And I think as other folks alluded to, it takes a lot of different skill sets to get a successful project off the ground. You have to often have government relations skill sets, technology skill sets, capital skill sets. So it's often unrealistic that one or even two people will have all of those. And it's not a good time to be sort of penny wise, pound foolish, that a really good financial advisor is part of the team to build a successful project and to be holding your hand coming and having these conversations and speaking this language with us.
Totally agree, David.
Good piece. Moving on down, Rick's got this great question about feedstock suppliers and is it valuable to have your feedstock suppliers a JV? We haven't really talked about feedstock yet, but this is one of the things that New Energy Risk is more recently really focused on. I'd say this is a fantastic idea. I see one of the most bankable scenarios being where you bring in your feedstock supplier, whether it's as a JV partner or you give them some sort of a dividend, but you don't want all of the upside to the feedstock supplier to be cash on the front end, paying them maybe a little bit less upfront, and then this upside on the back helps align your interests. It also helps improve your coverage ratio because you're basically moving them from an operating cost into an equity position, a common equity position. But I'm curious what the other panelists think of this.
Matt, yeah, I want to add to that. Kind of back to that platform story. What I've seen and I really like is when the JV is looking beyond one project, that it's a JV for a set of projects, and that the feedstock is sort of locked in different locations. That is a really powerful message and story, and one to get behind. Yeah, so definitely, pro that. Though I would also think through risks. I would think about who you're JVing with a little bit, because once you're there, you're now partners, and if there's some shady stuff under the hood, then that unfortunately lumps you guys together. So just be very wary of that.
Yeah, Kareem, I'd echo that. Like on the face of it, I totally agree, Matt. I mean, the alignment point for sure resonates. I guess it comes down to the quality of that JV partner, not just from a playing by the rules sort of perspective, but what is their creditworthiness, right? If you need to replace them, if they fall over, are they still an equity participant? There's some mess there, probably not, but it's a lot harder to fire a partner for underperformance than it is to fire a different commercial sort of partner, right? So I'd just be wary of that. And in all these feedstock conversations, especially in the bioeconomy, we've seen a lot of feedstock issues where there's real market risk there, and maybe it's still a fixed price contract, a fixed volume, tip or pay sort of thing. But the creditworthiness of some of these counterparties is not great. So we always look for a little bit more depth in that market to be able to replace, which is sort of intuitive and obvious, but just because you have a hard contract for 100% of your feedstock from ABC Co doesn't really solve the problem necessarily.
Jim, I was curious how you're, Jim, real quick, how do you see feedstock? Is this something that comes up in your engineering studies early on?
Well, I will say from experience, we were involved with a first of its kind biorefinery, and the feedstock was actually a fatal flaw in the running of the plant. So, the client developed a process and process risks around a feedstock that they thought they were going to deliver to the plant. When they went and put it commercial scale, there was enough variability of the feedstock that there was more arsenic in that feedstock than they had planned for. And that arsenic carried over and took out their bugs. And so what it did is it required another unit operation in the plant to clean, the syngas cleanup of that of the gas. And that was a fatal flaw for the plant because it could no longer meet its economic targets. So I would say if you have a feedstock supplier and it's a JV, and you can work with them and get the variability down to where your plant can operate on what they're supplying, I think your ability to get the plant up and running is going to be better. So I see an advantage there. And it helps with scale up. But,
I'll just add to Jim's point. One good practice I've seen here is that the engineering team will show you, we've sampled this over the year and a half before the NTP. We have the analysis, the variability is understood, and our design margins are built accordingly. But so it is solvable.
And we had, when we were under EPC and doing detailed design, we were getting late breaking news from the pilot plant on changes because they were working and negotiating around who their feedstock supplier was. And so you were getting late breaking changes that were actually costly to the cost of the installation.
Maybe just one thing I wanted to add is, it's a fantastic question because it opens the door for much also broader conversation around like the importance of partners and where is the gap and where is the risk. So, we're talking about supply side, but we talked about other things like project execution, sophistication of management. Maybe the biggest risk is on the offtake side. And everybody has their own experience, their own niches in terms of what they look at. But I would say that, first of a kind commercial scale projects, the conversion rate and success rate on these is lower than the vanilla sort of solar PV and wind farm financing. So one of the key ingredients to success is having good partnerships, and it brings the question of like, what is the role of a strategic investor in this? And it's definitely something that is worth considering. I think it does, enhance the chances of success for some of these projects. Maybe you do have to give up some equity upside to bring in that kind of partner, but again, it's a question of execution and success rate. And someone, if you have a lot of construction risks that are mitigated, but you have a lot of market risk in terms of placement of the product or demand for the product, then having a very sophisticated player that knows the market that you're trying to penetrate and has a good foothold there may be a fantastic addition to the project. Or maybe it's a large strategic, talking about energy transition, you've got a large strategic oil and gas company that's trying to pivot or improve their track record in the space, and they will be very financially committed to the success of the project and can bail you out or support if there are hiccups along the way during commissioning or early stage operations. So it's a great question, honestly, from that standpoint.
Great. As we're rounding up the hour, we've got a question about ESG and sort of how does carbon come into your thesis? So want to do sort of a quick round, and we'll start here with Duncan and then reverse order. I'll say that at New Energy Risk, we do think about this, but we do think about ESG more holistically. So we don't just carbon count. For example, we're in market with a tire recycling project, and that will actually be a net emitter. It would actually, from a carbon perspective, be better to just leave the tires in the landfill. But this is emitting, reducing other issues. In this case, there's some serious groundwater leaching that drives the project to want to dispose of its tires, not just landfill them. And so I'd encourage everybody to think about ESG impact more broadly. Duncan?
Yeah, likewise, Matt. And I mean, some of the things that we do aren't even in the energy transition space, like telecoms as an example. So we focus on, in that case, the S component, providing, closing the digital divide in that example. But on these energy projects, yeah, look, it's obviously at the top of the list, or maybe tied with risk and return. But it's we're not going to do projects that we can't feel really good about from that perspective. It is a big, broader question of how exactly do you measure it, and what is there's I haven't found at least a really consistent methodology yet that's applicable everywhere. And I think as an industry, we're kind of trying to narrow in on that and participating in that process. But certainly, if it's marginal in that regard, we're not interested. At the same time, we're not, and we've seen a lot of LPs say, like for bigger institutional LPs say, look, if it touches carbon, we can't even touch it anymore, which I think is, perhaps short-sighted, and actually provides an interesting opportunity for more transitional technologies. You can't solve all these issues with just wind and solar. And let's not get into the footprint of batteries as an example. So, we need to be fairly clear-headed about how we go about this transition process, and make sure that we're being really thoughtful about how we measure it. And yeah, we keep that at the top of the list for sure.
Yep, I've already kind of brought this up a little bit before, just to shed a little bit more light. So internally, like I said, we talk to hundreds of folks, every quarter, and so we have an internal comparison process. And Matt, unfortunately, we are very carbon centric, and that's our focus. And carbon equivalent counts, so methane, VOCs, the other stuff, it's all built in. Ultimately, we're gonna pursue ideas that sort of meet thresholds for us internally and are sort of in the top corner of IRR and a carbon story. And so that's how we think. I'm just giving you an inside scoop a little bit here. But that methodology, like Duncan said, it's unclear. There's a lot you can say there. Even Matt, with the tires, one can argue, well, you're displacing oil being drilled and the extraction. So it's still kind of messy. Just, get familiar. I think that's something that the more familiar you are, I think the better you're going to be equipped over time, especially as carbon credits, expand and carbon programs expand and carbon prices keep going up. So that's just an area good to be familiar with life cycles generally, and educate your investors for sure.
Carbon and impact is a core part of our due diligence and investment memo. So we are, as Vancity, an impact bank. Every dollar that we put out has an impact component to it, whether that's on the environmental, social, or governance side. I agree that there's not one consistent methodology. We use a particular one to measure the emissions avoided versus emissions generated and what the net is. But I think you'll see over the next couple of years, especially with all of the Canadian banks signing up as part of the Net Zero Banking Alliance and other announcements coming out at COP, that focus on impact and carbon will be increasingly important as part of the diligence and underwriting that banks, and in particular Canadian banks, do. So I think it's sort of the macro of why we're all here at this conference, and it's inherent in how we get evaluated and how we put our money out the door.
Thanks, David. Maybe just a couple of things is, so reinforcing, EDC has sort of clearly stated carbon reduction targets, but the discussion is broader as well. Duncan touched on it in terms of there's a lot of stuff that feeds under ESG, so water management, etc. And we do a number of things in-house. We have environmental and social specialists on team. We have technical specialists on team that will review that. And feed into, if we're doing a bilateral loan, we'll do our own diligence, but oftentimes we're working with partners, and that also bleeds into, each company is slightly different, and ideally you're tying your own KPIs to the company's success in their KPIs and making sure that things are aligned, and that those are the kinds of discussions as well that are happening with sustainability linked loans in the market. And the last piece I would mention as well is in terms of our partnerships. So EDC, where we come in terms of maturity of a technology, is usually at the commercialization stage. So before that, there are some of our partners like SDTC that have supported companies very often, or other arms of the government. And that assessment in terms of carbon intensity or environmental benefit has been done by them, and we obviously leverage that. And this is one of the benefits of having those partnerships across other crowns and agencies.
Tim, final thoughts? Okay, great. Well, thanks everybody for joining. I hope that this was enlightening. Certainly our contact information is online, so we hope that we can all be part of your partnership to pulling your puzzle and your project financing together. Back to you, Jeff.
Thank you, Matt. Thank you. That was very informative, and I certainly learned a lot. I want to thank you, Matt, and all the panelists for helping us understand what's needed to get more projects financed, leading to more bio-based steel in the ground. And I want to thank New Energy Risk for sponsoring this finance session. David Berliner, my goodness, penny wise, pound foolish. Wow, it's been a long time since I've heard anybody use that phrase, especially from someone so young. Maybe we can also talk about a stitch in time saves 9.
Oh, I don't know that one, but I'll try to use it on our next panel, Jeff.
That was great. Thanks very much. And Karim, you talked about the carbon tax. Yesterday you may have noticed that Canada's Prime Minister Trudeau is trying to get a number of countries to agree to a global carbon tax. And in fact, Canada's current carbon tax is $50 a ton, scheduled to go to $170 a ton by 2030. But I'm sure you're aware of that.
Yeah.
So we've got a 20-minute break now until our next and final session, which begins at 12:30. And by the way, guys, this is a special presentation on de-risking for successful scale-up. Our host is the Forest Products Association of Canada, and Don Roberts will be our keynote speaker. And Don's going to address some of the risks that we've just heard you folks talk about on your panel. He's going to be talking about de-risking technology, feedstock, and offtake for successful scale-up of bio-based projects. So listen, this has been wonderful. We look forward to seeing you guys all again next year, hopefully live for our annual Scotch tasting. So we'll see you all in 20 minutes. Okay, everybody, we'll be back in 20 minutes at 12:30. Okay, thanks very much, everyone.
Thank you.
Thank you.
Hi again, everyone. Welcome back to Scaling Up Day 2. We now have our special presentation on de-risking. And of course, as we all know, managing and properly allocating risk is essential to raising project capital, especially in a risk-averse market and where emerging technologies are concerned. Our host for this session is the Forest Products Association of Canada, and our session chair is Mahima Sharma. Mahima is Director of Environment Innovation and Mill Regulations at the Forest Products Association of Canada. Our keynote speaker is Don Roberts, President and CEO of Nawitka Capital Advisors Limited, and he's going to address de-risking technology, feedstock, and offtake for successful scale-up of bio-based projects. Don, I think you probably heard at the previous panel, which I saw that you were on, the finance panel, that one of the speakers talked about, for heaven's sakes, go out and find advisors to help you understand finance and finance language. And maybe that was a shout out to you, because I know that's something that you can certainly help us do and help us understand. So Mahima, I just want to say that if we have to run a little late, if there's lots of discussion and questions, don't mind if we go past the half-hour point, and I'm going to turn the session over to you.
Great. Thank you so much, Jeff, for those introductory remarks. As Jeff mentioned, my name is Mahima Sharma, and I work as the Director of Environment, Innovation, and Mill Regulations at the Forest Products Association of Canada. I wanted to start off by congratulating Jeff and the rest of the organizers who all helped together to make Scaling Up 2021 a huge success. With Canada's renewed commitment as a partner in the global fight against climate change this week at COP26, Canadians and businesses are increasingly encouraged to innovate, find new solutions that create jobs, and be leaders in technology development and deployment to achieve Canada's net zero commitments. As we think about the bioeconomy, it is of considerable interest for the development of continuous large-scale production of advanced bioproducts. I am so pleased to introduce Don Roberts today, who will be speaking about scaling up risks across the full project spectrum. As Jeff mentioned, Don is the president and CEO of Nawitka Capital Advisors. He is considered to be a global thought leader in the emerging bioproduct sector, and I'm really looking forward to hearing his insights today. Don, over to you.
Thanks very much, Mahima. It's a pleasure to be joining you today here. I guess one of the things that my presentations are usually very data intensive with lots of facts and figures. And today is going to be different. I'm really going to try to avoid death by PowerPoint. And instead, I'm going to mainly talk and try to guide a conversation regarding scaling up of bio-based businesses. Given our opportunity to have conversations during the pandemic has been very limited, I've set aside a minimum of half of my allotted time for Q&A. Now, in this concluding session, Jeff asked me to specifically share my thoughts on issues related to feedstock, technology, and offtake when scaling up. And to do that, I'm going to try to draw on my experience in sort of three areas. The first of all is in raising capital for biotechnology companies. And generally, we do that in sort of the $20 to $30 million equity range. But we also advise large strategic investors who are interested in engaging in the emerging bioproduct space. So we look at it from their perspective as well. And also, I'll draw on the experience that I've got, and I'm currently serving on the board of 3 advanced biofuel companies as we try to take things from concept to market. The first thing I'll focus on is the feedstock. And you have to sit back and say, okay, when you look at the clean tech space in general, what's unique about the bioeconomy here? And it clearly, perhaps it's obvious, but the fact that we're using a bio-based input. And that has some really important implications for both variable costs and cash flow. And which, it in fact makes it more difficult than in many other segments of the clean tech space. Has some important attributes as well, but there do come some challenges and risks. One of the risks that comes with, I think, using bio-based feedstocks is that the feedstock chain can be quite opaque. And that's a problem, especially for outside investors. And so that right there, you have, how do you deal with that? Well, one of the ways, and it was alluded to in the previous session, was to try to get biomass suppliers, if you can, as biomass or as equity investors in your company or project to help align incentives. Another way to do that, again, this was highlighted yesterday, was it's one of the reasons that we're sort of supporting the development of credit ratings for biomass supply, as folks like EcoStrat are trying to promote. So there are ways to deal with this opacity, but it is an issue you've got to deal with. One other challenge in scaling up in particular is within this space is the mismatch in terms of desires. And on the one hand, on the buy side, especially in the energy sector, and particularly dealing with transportation applications, you have this real need to be big, to move the dial, because it's a big market. On the other hand, there are some natural diseconomies of scale in a number of biotechnologies. And it comes about because of the low energy density of biomass. And that's a problem. You know, it's not the same around the world, and it's not also the same in all types of biomass. But what I would say in some of the traditional forms of biomass, whether it's the forestry, the ag sector, that problem is more acute in the temperate climates like Canada or Europe than it is in some of the more tropical regimes like you see in Brazil, et cetera. So on the one hand, if we look at it just from a processing point of view, we want to get big. We want those economies of scale in processing to move the market needle, but also to drive down both our variable cost as well as our capital intensity. And the capital intensity is an issue. And it varies by technology. But to give you a sense of one reason why you want to get bigger, there's one technology that I'm dealing with right now where essentially every time we double the plant capacity, it leads to about only so you double the plant capacity, but it's 1.5 times increase in our capital intensity. So it says get bigger. It also has a good impact on driving down our variable costs. Our challenge, though, again, gets down into the offsetting impact of size, which is that higher delivered cost of biomass in a number of applications. And it can be quite dramatic because this stuff is not easy to move, and location is very important. So this is one of the reasons when we look at, for example, new technologies and how we expect the costs to come down over time. And when we take empirical approaches to look at learning curves, for example, on how unit costs come down, we see that the learning curves for delivered or for biomass-based applications are often not as attractive as we see for those of other sources of renewable energy, things like solar or wind. And it gets right down to the issue is the fact that we're dealing with something that has a fairly big variable cost, whereas some of those others, it's all wrapped up in the capital cost. So having said that, how do we manage these diseconomies of scale that we can get in the delivered cost of biomass? Well, one of the things that I would say right up front is try to be as flexible as you can with regard to the types of biomass that you can handle. Now, it's easier said than done, but that is really one of the things to drive for. And there's two things I think which to bear in mind. Some of these constraints on us looking at different types of biomass are technological in nature, cost in nature, but some of them are also just cultural in nature. We've got blinkers on. And so we may grow up in a particular industrial silo, whether it's to be the forestry sector or the ag sector, and we think of a particular type of feedstock. And I would really encourage us to blow away those blinkers because money is at stake. Success is at stake. So also, if you're in forestry, for example, also consider the residue streams, you know, not just from your forestry mills and the forest biomass, but also from agriculture, over time from aquaculture, as we look into things like algae and so forth, but also industrial processes and municipal solid waste. So think broadly here if you can. And when you're thinking about that and assessing these different feedstocks, keep in mind the question, how can I solve someone else's problem? Don't push a string up the hill here. It's look for to see where we really add value. And that's key. Now, again, our ability to handle these different types of feedstocks will depend critically on our processing technology. And you've got to choose that carefully. And they're just not all created equal. That's just the fact of the matter. And I would generally say that those that are sort of thermochemical based tend to be a little more robust than those which are biologically based. Now, let's drive down a little more onto this thing on the feedstocks. And again, one of the things that's critical is what form is it in, especially as we're looking at scale up. So if you're having it in a form that's already in liquid or gaseous form, it's just a lot easier to handle than solid biomass. Because the latter in solid biomass often requires some degree of pre-treatment and it's more challenging on the materials handling. Okay, well, that's fine. It says go to liquids and gaseous if you can. One of the challenges, though, with liquids in particular, is really getting around the sustainable supply of them at scale. And certainly I found that to be an issue as we go out and try to secure it. But also, there's other folks more knowledgeable than I am who have a similar view. I think recently, if you look at the International Energy Agency raising specific concerns related to alcohols, for example, corn ethanol or any of the vegetable-based fuels, just with regard to can we really scale it without really having an impact on the pricing of it. Aside from, in many cases, the whole food for fuel debate, which varies by region and is not dead, by the way. It's well inactive, that debate, especially in Europe. If we focus on the cellulosic-based biofuels, and especially those in solid form, this physical supply is clearly much greater. And it can support, at the right price, and that's key, the right price, significant scale. But you really have to make a distinction here between the physical and economic supply that you're considering here. It's just critical here. In Canada, we think we've got a lot of trees. We see a lot, but a lot of this biomass is not as easily accessible or economic to use. And having said that, I'd just like to sort of just do a little footnote here for those in the audience who have more of a policy hat on. And it's really looking around that whole issue of how do you turn physical supply into economic supply. And that's critical, I would argue, especially as an example in the Canadian forest sector, where we need to mitigate the risk from wildfires, which are making forests a meaningful source of carbon, not necessarily a sink. And that's an issue. So we need some way to convert this physical source of biomass into an economic source for biorefineries. And just because we've got carbon for wildfires, just because that carbon doesn't fit nicely into our carbon accounting doesn't mean that it should be ignored. So having said that, let me move on and look at technology for a moment. And I'll start with some just general observations. Yesterday, I had the pleasure of listening to Brian Foody's presentation, and he highlighted something that I totally agree with. And that's the fact that right now, within sort of the cellulosic fuels, it's really renewable natural gas, RNG, which is getting the greatest share of investment in the biofuel space. And the question is why? Well, one, it's relatively low technology risk. Well, that's great for an investor to hear. The second is that it's really quite capital efficient and cost effective. So unsurprisingly, it's offering a lot of the low-hanging fruit out here. Now, our challenge there, once again, is going to be on the supply side of this. We've got to get, and we're already getting some constraints on some of the traditional sources like the landfill gases. And we're seeing new investment starting to move into the ag residues and the forestry residues. But again, the question is, can we do it at scale? And it's going to be, my sense is more of a decentralized model out there, one which I actually kind of like, the notion of decentralized solutions, but it does have some challenges on scale. If we look at the market aspect and challenges for the renewable natural gas, a lot of it is going into concentrated natural gas, which is, you know, quite frankly, it's a relatively niche transportation fuel market. But that's where we're seeing it, especially in the California market, where the LCFS is drawing it in. Over time, yes, there is opportunity here in the higher valued utility gas supply. And longer term, I think there is some potential for gas to liquids technologies. But I must admit, I'm a little bit of a doubting Thomas there on that latter, simply because, again, scale is very important and it is very capital intensive. If we look at another aspect on the technology, another pathway, one that I've tended to focus a little more on, and those are the thermochemical pathways. Now, they're continuing to be developed. I think they still need to see greater scale to be more cost competitive, but we're seeing progress there. You know, I'm happy to see Claritin's, for example, their the new cellulosic ethanol plant that they're putting up in Romania and commissioning, and that's got some decent scale. What we're also seeing clearly is progress in both the hydrothermal liquefaction as well as the fast pyrolysis to produce biocrudes. And again, that is a bit of a what I would call probably a hub and spoke model that we'll see to support scale, where you'll see the biocrude go in to be co-processed, usually at an existing oil refinery, up into the higher and final consumable products. But we're also seeing, I'm happy to see, some developments on upgrading of this biocrude with standalone upgrading units to put either, again, to support a hub and spoke model, or maybe if we can get it at the back end of a fairly large biocrude facility. And those are technologies, for example, what Shell Catalyst and Technologies are developed, as well as UOP. And so those are some interesting ways to get scale and drawing on sort of the existing capabilities out there, certainly in the co-processing example of the oil and gas refining space. If we focus just specific on scaling up of plants here, again, for solid biomass, I thought I'd just sort of share with you some of, I guess, our experience and dealing with solid biomass. So there's a prudent rule of thumb that we use, which is about a sort of a 10 times scale up at each stage. And it means it's a long process, quite frankly, but it helps us to manage some of the unique challenges in dealing with biomass and the handling of it. Also, one way to deal with it is really a modular approach to help mitigate risk. And I think that is a prudent approach. You do forego there is some trade-off with the sort of process economies of scale and the reactors and so forth, but it's still a way to sort of manage that risk. I would also say that as you're thinking about this scaling up, it's really important to take a holistic approach, a systems approach when looking at it, to see what scale-up factor is reasonable. And I say that, and drawing on some of the experience, for example, that the folks in the cellulosic ethanol space had, where they had done, at least from my perspective, it appeared to be most of their due diligence was done on their primary reactors. And they felt comfortable that they could get those running at the larger scale. However, it's just part of the system. And probably based on experience of what I see, you know, again, just from a distance from maybe what Abengoa did and Poet, is that there wasn't enough work done on again, that pre-treatment steps. And so, yes, the reactor work, but you have to have the right things going into it. And it has to be clean enough. And in a number of cases, if it's not, then you can really drive up, due to contamination, your maintenance costs. And that can be a real issue. It really can. Also, again, this whole issue on what form it takes, and it varies. You'll look at, which allows you to scale up. Take the example of UPM Kemira, the large Scandinavian-based paper pulp company. They were able to do quite a large scale up in one jump at the La Parenta plant, their biorefinery. For example, took it from essentially a pilot plant, really quite small, to about 40 million gallons. And so how did they do that? Well, they did it partly and were able to take that calculated risk because they were using a liquid feedstock. You really wouldn't want to do that with a solid feedstock. And I'll give you an example of someone who's used a solid feedstock. For example, the fast pyrolysis company BTG out of the Netherlands, where they use forestry biomass. They are effectively limited to, and they say it publicly, to do about a 5 million gallons. So not the 40 million that you saw UPM do in one jump, but they're limited to 5 million. Why? Well, it looks like it's largely due to heat transfer issues. And so that they're focusing more on sort of niche applications. Aside from the nature of the feedstock, some other key questions that you just got to ask in that scaling up question is, how much of this new equipment is really new in your system? How much is off the shelf? And even if a fair bit is off the shelf, how important is that integration risk? Not to be dismissed, that integration risk. Now, that's where we are seeing, and again, some of the previous panel, in fact, touched on, is there then a role, and I think there is, for things and providers of technology risk insurance? And clearly, whether it's New Energy Risk or Munich Re or some others, we are seeing that service provided starting to be available out there. And that's really good news, I think. So we're starting to essentially see these groups provide what I would call efficacy insurance around the startup of first of kind commercial scale plants, which do have still some meaningful scale up factors, but we can insure against it at a price, of course, at a price. We're also starting to see these providers move into providing the type of insurance that historically has come from the EPC contractors. And that's especially, again, relevant for the larger projects. So those are some of my thoughts on the technology side. Let me now just quickly jump over to the market side. And here, what I will say is, of course, every investor wants a bankable take or pay off take agreement to mitigate market risk. The reality is, anyone who's been, for example, in the power space is going to be quite disappointed when they come into the liquid, fuel, and chemical spaces, because you're not going to get those kind of ironclad PPAs. So you get what you can. To the extent that you can't nail down the ideal, focus on really trying to get and produce a product to a specified ASTM standard. So it means you're generally on the commodity side, but get something which is, seem to be fungible. Also, again, it'll help if you can get your customer to be an equity partner in your project. That also conveys to the investors some degree of confidence that you can have a market here. One of the challenges you'll see for more specialized products is that you really do need to get those solid offtakes, because if it's a specialty product and that market isn't there, you've got a problem. Best example of one of the contributing factors that was, I would say, to BioAmber's experience, bad experience that they had for not having quite those contracts for the succinic acid that they produced. Lastly, on the market side is that investors, I think, correctly see that regulatory risk is meaningful, and that is often translated through the market. And what we want as much from the regulations is just as much transparency as possible. And generally, we don't like changes. Now I'll just jump over onto the financing side. And on the financing, one of the key questions I tend to ask here is that what is your business model for scaling up? It's important that you get that clarified quite quickly before going to financiers. There's a common, I think, objective out there that people do want and are open to is that on the financing is that they want to see and help develop a platform and then finance a pipeline of projects. And an increasing number of funds like this idea because, one, it allows them to, to meet their minimum capital requirements for deploying. And they also, do see that they can get a multiple bump as the technology builds up a track record over time. And the whole, I think, group of sort of clean infrastructure as an asset class is certainly growing, with an emphasis, I would say, on the infrastructure side of that, even more so than the clean in terms of their risk appetite. At least that's my experience. So before you engage with the financiers, though, again, be clear on your business model. Is it, for example, what I hear often from developers is they want to be the builder, the owner, and the operator. Well, that's nice, but that does a lot. And what role is the investor going to play here? They're not just going to give you a free check or give you a check and allow you to do everything here. So alternatively to that, are you willing to consider to be a developer and a manager of projects? Or maybe you're just into licensing fees, that model. But clarify in your own mind what your risk appetite is, because if you're a builder, owner, operator, that has important implications for your dilution down the road. And as you're, again, going out to investors, recognize that not all of them are created equal here. There are very, very different strategies out there in the capital markets. And some, for example, focus mainly at the parent level and where IP is especially key. And if that is the case, you'll tend to see that people will focus there, while other investors are much more yield oriented and they're going to focus at the project level. I think there's something to be said. If you can keep it at the project level, do so, simply because you're going to get less dilution at the parent. And bear in mind that as a technology company, your real value creation comes from just demonstrating that your technology works, even if you don't own that plant or don't control it. The last thing I want to just jump onto and touch on to here on the scaling up is what may be the most important issue, and that is the team. You really got to get a dedicated team with sufficient breadth and resources. And if you're a strategic investor, you cannot do this by adding a third file at the end of the desk of one of your, smarter people. You've got to have a dedicated team to do this. This can be difficult because there's not a lot of people who are out there who have got what I would say the ability to say, been there, done that. And that's important here on your teams as much as you can. It's really important here that, and just recognize you learn more from your mistakes than from your successes. And so be open to previous failures. I can think of an example was working with one strategic where they were looking at a potential partner and they had failed the individuals in innovation in another sector. And they said, nope, won't have anything to deal with them. Wrong answer. Because if you want to get people who've got some learnings and know how to avoid them in the future, because there will be unexpected shocks to come at you. So one of the things that I would say in this team, get it broad, get it dedicated, and make sure that you have some tolerance for failure. You're not going to look for it, but if you have no tolerance for failure, and I'm thinking here again in terms of the strategics, then you're going to be too risk averse and you're going to get nothing done. So be willing to accept some failure and learn from it and mitigate it. Have a very clear risk register that is well thought out. I generally also, in looking at the team for technology companies, I generally prefer have at least strategic investors at the table. And when you do that, you look for within that strategic investor, you need a champion somewhere in the C-suite of that player. And the role of that champion is really twofold. One is to protect the team when things go wrong, because they will. The second is to help guide that transition from a technology company to a deployment company. And this is where a lot of the technology companies fall flat in their face, that transition. Lastly, I'm just going to give, for those who are looking at projects in Canada, what I would say is I would strongly recommend that at a fairly early stage, you engage with your local First Nations. I mean that seriously. They are not stakeholders in Canada. They are rights holders. And you better recognize that, or down the road, you may have some other issues that you don't want to deal with. So I just say that. Having said that, I'd like to now turn it over to you, Mahima, and happy to have a conversation.
Great. Thank you so much, Don. That was very, very insightful. I loved what you said. You will learn more from your failures than your successes. And I think that was some great insight that you shared about scaling up. So just a reminder to everybody, please post your questions in the Q&A. So Don, we have one question already. So I'll start with that. It's from Rick Ingram, and it's, please describe the type of relationship you would have with a scaling up bioeconomy company.
Okay, well, so this is, every advisor has a different one. I get in deep. I have a fairly narrow, I used to do a lot of general clean tech. Now all I do is emerging bioeconomy. That's what I do. And so I'm involved not just in advising capital, but I tend to get in earlier on advising on the strategy as well, on what makes sense, what is going to be bankable at the end of the day, and helping them develop their team. In some cases, I actually go on the boards. We have invested in some, and others, it just goes, as a board member. But it's working on the strategy, helping them raise capital, link them into the ecosystem. Often this will also look at not just, and we raise capital, it's not just with financial investors, it's also with strategic ones. It's also, we're working in governments. This is a sector which, quite frankly, would not have nearly the momentum it has if it were not for government intervention. And that's because we are here because of a market failure. And so governments have a role there. And so I deal with governments as well. So that's sort of my roles. We're there for a long-term ongoing relationship.
Great, thank you. I guess, well, we're just over the 1 o'clock time, but Jeff said we have a little bit more time. So I'll ask one more question. So this week at COP26, Prime Minister Justin Trudeau championed putting a price on carbon. And then we're projecting to see an increase up to $170 a ton by 2030. So given the 5 risks that you spoke about, feedstock, technology, deployment, market, and financing, what do you see as a key role for the federal government to play to help facilitate offtake of some of these technologies?
I think the biggest they can do is do the clean fuel standard right. Get it right. And one of the issues that we see in the implementation of a lot of these, whether it's the clean fuel standard here or the ETS trading system over in Europe initially, in order to make things politically palatable for governments, what they often do is put in place measures which get a lot of supply, an oversupply of credits out there. And just to make it easier for the incumbents and the obligated parties. What that means is that the price signal tends to be very depressed, and people just sort of then back off. And so get that one right, focus on the price signal, and make sure that that price signal is transparent. Post it. This is going to be a thin market to begin with, but this is how you get new innovation in, and not just the incumbents dealing with it. So that's what I would recommend.
Great.
Don, I have a comment and a question. Sorry, Mahima, did you have another one?
Nope, I'll pass it to you, Jeff.
Okay, thanks. Yeah, my comment on what you just said about get the clean fuel standard right. I'm absolutely appalled that when what we heard yesterday, and I mean, I was aware of this, but perhaps not in the detail that Ian Thompson described, that we are not aligned with our clean fuel standard with either the US or the EU. And there we have the state of California, and I actually have personal experience with this when I had the California Energy Board people come up here and talk to the All-Party Climate Caucus about what they were doing down there in terms of vehicle standards. But there we have the state of California saying, well, we're here to help, and yet somehow Canada seems to have designed a clean fuel standard that is a complete train wreck. So that's just an observation. I'm really appalled by that. Hopefully we can do what Ian suggested and put some guardrails around it so that it is actually functioning the way it was intended. But you can comment on that if you want. My question to you though, Don, is you mentioned all kinds of risks. To whom are these risks best allocated? Now, presumably they're best allocated to those who can best assume them. For example, a construction risk would be best assumed by the EPC contractor. But can you just talk a little bit about proper allocation of risk to the correct parties?
Well, I think the financial markets in some respects are, if there's enough information, they're good at identifying and pricing risk. Pricing risk is the challenge for a lot of folks. It really is. And so I think things like this, the credit rating on the feedstock in some areas is a good idea. I think the risk insurance is. One of the areas that I'm involved right now in actually getting things built, and so we're moving beyond just the technology. It's actually the construction and the deployment side. And I think having someone who's got the experience in building these, for example, biomass liquids plants is just critical. And so, for example, you look at, you got to get into the details. So I would look at folks who are now nosing around in this area, guys like Poet, they have done a lot in the area. They've got a good internal EPC capability built up, and yet they're not building ethanol plants anymore. Well, that's a great example of someone you could partner with then to sort of build and redeploy that skill set and really reduce a lot of the risk. So you don't have to go out and pay for some of this other risk insurance. That's another way to sort of self-insure. And so I would say you have to be specific on the situation you're in. There's not one just general rule out there. The regulatory risk is a big one. It's a concern, I got to tell you. And one of the things is, again, don't aim for perfection, get it good. And so one of the things is that I would say in the case of the low carbon fuel standard, we've got one in Canada that's working quite well. It's British Columbia. Just say, point over the rock and say, give me one of those. Because we want to see where it's got a track record. But that would just be my own sense. And the other, so I'll just leave it at that, given the time.
Thank you, Don. Jeff, I guess we don't, we're out, are we out of time now? You'd say we're well past 1 o'clock.
Well, it's true. I saw somebody sending a great big long, I haven't had a chance to read that, Mahima, have you? There's a big
No,
long.
but I have, there are a few questions. So maybe I'll put forward, there's a big long question here, Don, so we'll just read that one here. You recommend thinking broadly about biomass feeds, such as flexibility with biomass feedstock qualities is essential to achieving the volume and price needed for financial success, especially in large capacity biofuel projects. On the other hand, variability is the enemy of continuous processing and leads to inefficiencies in difficult to predict ways. While biofuel technologies claim success handling the range of biomass qualities, firstly, the biomass pre-processing for different biomass types, and secondly, the impact on operating efficiency due to feedstock variability are not effectively de-risked, especially for gasification-based processes. How do you see balancing biomass flexibility and risk relative to project development? You talked around this issue with your examples, but do you have advice to offer in terms of risk management from the investor perspective?
Sure. First of all, you're right. It varies by which of the pathways you take. I'll lay my cards on the table. I'm not a big fan of gasification. I find it's too capital intensive and it's a little too finicky. That's just my perspective. What I would say here is that this is one of the reasons I'm looking at a hub and spoke model, where the spokes would have different forms of biomass feeding in. So within the spoke, you can manage that variability. So you may have one that's on forestry, another on ag, another which on, say, biogenic from MSW. So that's one way to do it. The other thing is that I would mention here, there's a difference between, I can have a mixture of different feedstocks, but I want a consistent mixture. So I can still see with variability, in the mix, but I want to try to get that consistency to address exactly the issue that you've just mentioned with the variability. I don't want my diet changing a whole lot, but I can have a mix in my diet when it's consistent.
Excellent. Thank you so much, Don. Jeff, I guess I'll pass it back to you now.
Okay, thanks, Mahima. That's great. And thank you for chairing this session. And thanks to the Forest Products Association of Canada for sponsoring this session. Obviously, even though we've run 10 minutes over, we haven't lost any of our registrations. So registrants, people who are attending, are still keen to listen. So thank you, Don. It's been a very informative and engaging way to bring our 2021 conference to conclusion. And sadly, yes, that is it for Scaling Up 2021. I really do hope that we'll be able to see each other face to face at Scaling Up 2022, which is next November 14 to 16. So please put those dates in your calendar. As you can see here, the theme for next year is Pressing Forward, Replacing Hydrocarbons with Carbohydrates and Beyond. And of course, the beyond part would be oils and fats and greases and so on, and the carbohydrates clearly forest and ag and so on. But yeah, put the November 14 to 16 dates, and we'll hopefully be all getting together face to face. I also want to thank our sponsors. Again, our overall platinum sponsor, EcoStrat, our gold sponsors, Iogen, Steeper, New Energy Risk, Cumberland, and Advanced Biofuels Canada. Our silver sponsors, Munich Re and the Forest Products Association of Canada, and our supporting sponsors, the Future Economy, Advanced Biofuels USA, GreenPack, and the Canadian Wood Waste Recycling Business Group. I thank you, and all the conference registrations thank you for the opportunity you as sponsors have provided, because without such sponsors, Scaling Up would not be able to proceed. So again, a big round of applause to our sponsors. And thanks, of course, to all our panelists and session chairs, and thanks to our audience for attending. We've had over 400 registrations, and those who were unable to get on live, everything will be available on YouTube in a couple of days, and so you'll be able to watch the sessions you missed. I trust you learned something, and I hope to see you in 2022, when I expect we'll all be getting together face to face. So thanks again. It's Jeff Passmore signing off. See you next year. Bye for now.